So yeah, really great to have you guys here. This is I'm Danger from Today in DeFi, and yeah, we've been following Liquidity for like years now. We covered like Liquidity V1 when you guys came out, and yeah, it's cool, great to see Liquidity V2 coming out. You guys are like the one really decentralized stablecoin. Um, so yeah, can you guys maybe tell us about yourselves and why you started, I guess, why you guys joined Liquidity?
Sure. Thanks for having us. So I'm Michael. I'm the CEO of Liquity. I joined more than 3 years ago. So after they launched V1, so Robert founded it, co-founded it with Rick. First joined as a CEO, helping run the company, and then moved into the CEO position, so that Robert can really focus on the research side. My background is computer science and economics. I always worked on the intersection of business and IT and the user experience. Um, then in 2017 and end of 2017, I jumped into crypto, was during the ICO craze, and then founded my own startup, more gearing towards traditional financial institution. Just realized it's too early, and DeFi is more fun and kind of has to go to market. So, and why did I join Liquidity? I really love the project and product once I heard about it because it's so truly DeFi with the immutable contracts, decentralization. I think that's what Ethereum was built for. And also the Robert, the founder, lives really close to me. So we started chatting, and that's how it gets started.
Yeah, it's a pretty brilliant project. Like I feel like Robert and you guys have to be super smart to put together something like that's immutable and also decentralized like this. Um, yeah, and yeah, how about you, Colin?
Yeah. So I started my career in finance, working in TradFi. So I'm based in Europe and I work for a French bank, initially in Paris and spent some time in London and New York, working on a trading floor. And about 10 years ago, I had this opportunity while I was there to kind of look into blockchains and cryptocurrencies. And kind of the first job I had then was, this Bitcoin thing is something that we hear people talking about. Can we make money out of this? Which is funny when you read people's reflections, especially at the time, about how banks hated Bitcoin. No, banks were just trying to figure out if they could make money out of it, and I was one of those people trying to do it. My answer after about a year of spending time trying to get the bank to look at it was, we can definitely make money out of it, but you will be too slow. And so I left there to kind of start doing stuff that we now refer to as DeFi back in 2015, and worked with a number of large companies from big TradFi to smaller kind of boutiques, as well as startups, to build a lot of these things, and kind of went full time into it. Um, Went back and forth doing kind of more product roles, more development roles. Spent some time with NFTs. Love all the kind of on-chain stuff. And about 18 months ago, I had been aware of Liquidity from a distance. Met the team, really liked them, really liked the vision of where they were going and the challenge with V2. And so joined the team in, was it summer of 23, to kind of come on specifically leading product for Liquidity V2.
Cool. Yeah, I feel like to to be with Liquidity, you have to be a little bit cypherpunk because it's like super decentralized, and that's
Yeah.
how what makes you appreciate it. But yeah, I've been looking at V2 and I feel like there's like a lot of like business sense around V2 as well. Like you guys have like addressed a lot of the issues with V1 and also like have like what seems to be like a really good go-to market. So I'm excited to dive into it. And and yeah, V1 was really cool. It came out quite a few years ago, and like at the time, it was like incredibly innovative because like everything else, like the main decentralized stablecoin before was MakerDAO, and like theoretically it was quite cool. But then like if you actually look at the way it worked, basically there's like a huge uh DAO, just like this really bureaucratic, like manually set interest rates, and they would like talk and discuss the collateral and stuff. And it was cool to see that decentralization, but like you could also see that like doing it that way was like a lot of overhead, a lot of like manual, like even though it was like technically decentralized, but it was like a lot of people pulling levers and stuff. So could have been a lot better. So like what you guys did with V1 was pretty amazing, where it was just a set of immutable contracts and like like even the front end was decentralized. So could you guys like maybe quickly tell us about V1 and like how you guys think it like compared to other stables and maybe like why you guys moved on to V2?
Sure, I can give some background. So Robert, who founded Liquidity, saw a maker and thought, hey, we can make that better, or wanted to make it better. First, and he introduced interest-free loans. So if you have an autonomous system that doesn't need kind of all the handling, he pioneered that. So with Liquidity One, you pay only a one-off fee. Then you have higher loan to values. He introduced instant liquidations to make the product more resilient or allow high loan to value ratios and a higher capital efficiency. So these were the main driver to establish that with V1. And I think what it also established is, I think it's something you would expect that you naturally have on Ethereum if you have a base asset like ETH, so that you are able to borrow against it and have a native stablecoin that is just backed by ETH and 100% on-chain. And it still puzzles me, kind of that probably Liquidity is the only one that delivers that in such a pure way. And yeah, it's kind of still a minority stable coin because all other stable coins are a mix of it or have assets off chain. So I think it's that very pure product for ETH holders that allow you to do something with your ETH asset without giving up too much control. So for people that don't know Liquidity V1, it's similar to Maker. You can borrow by depositing your ETH collateral, take out the loan in LUSD, that's the stable coin. You pay a one-off fee. And on the other hand, as a stablecoin holder, you get a really resilient stablecoin, which you can deposit in the stability pool, which helps with liquidations. There you can earn some yield. Yeah, I think these are the two main use cases, and that's how our user base looks like. So you have the borrower or the ones that want to do leverage. You have, on the other hand, the earners or the people that just want to hold an unstoppable stablecoin where they have full control over it.
Yeah,
Oh, and just
mhm.
one side note, it has been live since 2021. So that's really impressive. So the protocol on its own, totally autonomous, as we said, no governance, nothing. It was just running like that. And in that time, comparing that to TradFi, where Colin is coming from, where you have a back office, where you need a lot of stuff. This protocol was running on its own and managed to process 4.5 billion in loans on its own. And I think, that when you ask what fascinates me, exactly that. You can do that only on Ethereum in that way, I think. So
Yeah,
that's the story background of V1.
yeah, it's pretty amazing. I remember like actually back in the day, like MakerDAO did have like a ETH only stablecoin. I think at some point it was called Psi, like single collateral DAI. And then they phased it out in favor of like RWAs and stuff. But like there's still so many people who really wanted to have, ETH, just simply ETH backed stable coins. So it's awesome that you guys built that and that it was like running like basically, autonomously for all those years. Yeah, that's just really incredible. Yeah. So yeah, can you tell us about like V2, like what inspired that? What the changes are from Liquidity V1?
Yeah, so maybe I'll let Michael come into what inspired it before I joined. But kind of the big changes is our innovation. We built off a lot of what we did and we knew worked with V1, and kind of chiefly that was what we call this redemption mechanism. And in short, what the redemption mechanism seeks to do is kind of create a floor price for LUSD and now Bold, the stablecoin in V2, at about $1. What that means is if the stablecoin depegs downwards, there is a mechanism where anybody holding the stablecoin can come back and get the underlying collateral. In the case of V2, that's ETH plus 2 LSTs, Lido wrap staked ETH plus Rocket Pool ETH. So very high quality decentralized collateral. So this makes it very resilient and helps protect against downward depeg, which has been something we worry about a lot in stablecoins with CDPs, so a collateralized debt position. Again, this is kind of the model that Maker really innovated back in the day. We have also sought to kind of fix some of the other issues, which is the depeg the other way. And the way we do that is through our second innovation, and this is user-set interest rates. As you heard Michael say, with V1, we had interest-free borrowing, which is a great product as a borrower. It's more difficult as a lender, a stablecoin holder, because it's not really clear what you get, when you might get paid, what you get from holding this token. So it's great that it has utility as a stablecoin. It's worth $1. When we're in an environment where people want to get paid for holding a stablecoin, want to be able to stake it, use it for things outside of just that, it's not exactly clear how much that should be. And why does that kind of result in this? Well, people holding these stable coins either hold them speculatively against somebody getting liquidated, and they might get paid for that, and they can sell it back maybe even for more than $1, creating some kind of squeeze in there, or they are holding it for some other kind of purpose. With user set rates, users are able to borrow at any rate they choose, which means in our system, the way they do that is they look at what is the chance I'm going to be redeemed. And if there's a very small chance, meaning I'm above peg, I can borrow at 0.5% a year. It's extremely cheap to borrow. This means that in markets where things crash, like what we saw just the other day around the US tariffs scare, people were dumping Ether. And we had this flash crash. It went down from, what was it, trading around 2,800 to 2,100 in the course of a couple of hours. We kept pretty close to stable. We're growing. We're a new stable coin. It's great to see a stress test. We're not at cruising speed quite yet, but we could see that the system was already really resilient. People were going in, piling into stable coins, including Bold, even though it was very new. And people were able to go out and issue new loans for very, very cheap to take advantage of this, that were highly overly collateralized. So they weren't worried about liquidations. And it just kind of proves that this model in those types of market conditions can be very robust. Over the long term, we can also protect against lots of redemptions, which is the problem with V1, where people, to move away from redemptions, had to add more collateral. Not that they were worried about liquidation, but to kind of move themselves away from being redeemed against, by which I mean somebody holds a stable coin and takes your collateral and repays your loan, which is obviously not great if you want to hold Ether. In our new system, we allow a user to increase their rates anytime they want, to kind of move away from the leading edge of redemptions. And in turn, that creates a system where it's more profitable to hold the stablecoin, which should bring it back up to peg. Those are kind of the main things, building off of redemptions, changing how the redemption mechanism moves, and making it more economically viable in a wider variety of markets to help protect against depegs, both upwards and downwards.
Yeah, I guess like
to add on that,
yeah,
maybe just quickly, taking even a step back, I think actually there are 4 innovations, and Colin touched, I think, on 2 of those. And I think what's really the cool thing about this team, going back why I like Liquity and why I joined, is there's a lot of innovation. And if you compare it, what else is happening in DeFi, there are many protocols that are able to kind of pioneer so many innovations. So we have user set rates where you can borrow on your own terms. I mean, that's even new for TradFi, not only DeFi. And it's really very interesting to see how that plays out. We have also, we're passing through 100% of the revenue from the borrower side to the stablecoin holder, and we can touch on that later. What is the impact of that? How does it make the earned product more interesting? But also something you haven't seen really done, that this is funneled directly on chain, and really interesting to understand how other stablecoins work then, how their revenue flow works. Then third thing we introduced is protocol incentivized liquidity, meaning the protocol on itself ensures that there is liquidity on chain, predictable, autonomous. Also something nobody has done before, as I'm aware, or kind of on a large scale. And the last thing is how we bootstrap V2 with forkonomics, kind of how we can, together with forks, bootstrap the ecosystem of stablecoin. I think these are the four things I think is really innovative. Something that we kept, but it's also important to say, is the ethos, trying to maximize decentralization, immutability, all these qualities. We tried to keep them at the same time.
Nice. Yeah. Yeah. Those are really great. Yeah, the forkonomics thing I think is also really cool because in the past there's so many Uniswap got forked with SushiSwap, Aave got forked countless times. So like proactively working with those forks is like I think it's super smart. Yeah, and looking forward to touching on that in a bit. It would be really cool to like so now we know what the differences are between V2 and V1. It feels, if I'm understanding it right, it's like I think it seems to me when I was looking through this that I guess one of the central differences is user set rates. But then that actually, even though it just sounds like one thing, but it actually seems to, I think that actually influences a lot of things. So that's pretty exciting. Like for instance, the stability pool. Like I use the stability pool in V1. I remember getting really good rates there. Like whenever there's a liquidation, you get a bunch of money, and I think these rates also help that. So it'd be cool to dive into that a bit. Would one of you guys be able to like share your screen and maybe walk through how like Liquity V2 works and maybe some of the use cases?
Sure, happy to do that. And let me just pull one up here. So I'm going to make sure I get
And
the right
while
one
Colin
here.
pulls it up, what he will show is probably three use cases. So the borrowing, and I think what we can offer there is really trying to give people a benchmark rate for borrowing in ETH, so to be the go-to place because of this efficient protocol efficiency between borrowing and stablecoin holder. The second product is the earn, or you have the multiply, but then also the earn. I think there we aim for the best risk-adjusted yield on crypto dollars, and we can tell you then later on why we think we can achieve that with the new design. But Colin, I see you pulled it up.
Just answer my question whether you can see it. So yeah, so this is a front end from our testnet deployment, just to kind of be able to walk you through it. So as Michael said, in short, there's a number of different ways you can use these products, and some are still being kind of rolled out, including our leverage position, which will help kind of manage being able to do looping and that kind of things as liquidity builds for Bold. But for now, let's talk kind of about the central ones, which is borrowing, what it means to set your own rate, and also, as you alluded to, with earn, and how you would benefit from that borrowing as a stablecoin holder, as well as from liquidations, as you alluded to. And then we kind of have a related thing, which is where a token fits into this, and the staking aspects. So hopefully you can see this all right. First
Can
thing
you make
do
it a
when you come
bit
in,
bigger? I'm not sure if on my screen it looks really small. Yeah, maybe like that.
That looks great
Oh.
on here.
So you come in, it looks very similar if you've used any kind of CDP borrowing before. You put in your collateral. As you see, we can select from a few different things. I'm going to use Lido here. Ignore the numbers, it's testnet. We just threw in numbers when we were building the testnet. So this is actually running against Apolia. We had just a fixed price against that to make that a bit easier. Put in your collateral, decide how much you want to borrow. We have some preset things, so I'm just going to say 10,000 Bold. And you select an interest rate. There's a couple of different ways you can do this. I'm going to go over kind of the basic manual stuff and then talk about where we're going next. When you first come into this, you'll see a couple of different things in here. So obviously, the first part is you select your own rate. As I said, it can be anywhere from 0.5% all the way up to, here we stop out at 25%, but it can go up. The system can tolerate it at 250% maximum. We hope we never have to see anywhere near that, because that would mean the system is having lots of problems, or there's a whole lot of degens that love our system, and ETH is pumping, which would be great to see, but it's harder to be a borrower. So I'm going to come in and I'm going to pick a number around 5%. And the reason that I just decided to pick 5%, well, I saw what the market was doing. But here we look at this redemption risk. As I said, this is the risk that if the stablecoin is below, people can come back and take collateral. Where do they take it from? They take it from borrowers. In my case, if I'm way down here in the beginning, there's nobody redeemable from me. Essentially, we keep a list in the system on the blockchain, completely transparent. Anybody can go and query it and build models around this. But we say how much bold, how many stable coins would need to be redeemed before my collateral was touched. So we create that calculation here, starting from the lowest interest payers all the way down to the highest interest rate payers. And in the front end, we say how much is here. Obviously, you can see the numbers larger than our current TVL so far.
Well, so just to review, just to review a bit, so users can set their interest rates, and then the people with the lower interest rates will get redeemed before the higher interest rates. And what does redeeming mean again? For Liquity?
Yeah, so redeeming means I'm borrowing. So in this case, I put in 10 Lido wrap staked ETH. I'm borrowing 10,000 bold against it. If somebody's able to acquire bold for significantly less than 10,000, so let's say 9,900, they can come around to the system and they'd say, hey, I'd like to return this bold, essentially burn it, but I want $10,000 worth of collateral at the rate that Lido wrap staked ETH is. They'll be able to withdraw that in the case that I'm the lowest interest rate payer from my position, repaying my debt. So I, as a borrower, no longer have my Lido wrap staked ETH, but I also now have $10,000 less worth of debt in my system. So somebody has repaid my loan on my behalf and taken the collateral that represents.
Okay, so it's definitely not as bad as a liquidation, but it's still something that maybe borrowers might want to try to avoid.
They definitely would want to avoid. I like to say it's not the same as a liquidation, but it is a cousin of a liquidation. It is a forced mark to market. But in this case, you're not paying a penalty for being liquidated. If the price of ETH moves up, obviously you're not making as much money as you would have liked to by keeping that collateral. And depending on where you are, that may also have tax implications. Of course, we don't give any advice on taxes and all that great stuff. If you're using it and worried about that, do talk to somebody that's qualified to talk about that. But those are some considerations that users have talked to us about.
Got it. I guess that's a pretty good incentive to not set the interest rate to like 0 or something.
It is a very good incentive to do it. And so far what we've seen from a live example, now that we've been live for nearly 2 weeks, is it is actually a pretty powerful thing. So what we saw with V1 is this was probably one of the biggest headaches users had. They liked a lot of aspects about V1. They really didn't like being redeemed. So it's a pretty big lever that people don't want that to happen, even if at the moment it happens is not financially as punitive as a liquidation. It's not a liquidation. It can happen at any moment, no matter what happens with the price of ETH. The value of your collateral could be up, in which case they'll take less collateral than they would. But it's based in V2 strictly on how much you're willing to pay. After you've opened your position, you can come back and you can change it at any time. There's a bit more nuance to it, so we'll come into that. But in short, you can change this and you can move up to kind of pull yourself away, which means you're paying more in interest.
That's super cool. It seems like it makes V2 a lot more like flexible and robust in like various interest rate environments. Like the Fed is gonna potentially lower rates this year, I guess. So like if you had like one fixed rate, then it would not be able to account for that. But now with these user set rates, Liquity can adjust for any kind of interest rate environment.
Exactly. And one kind of important thing there is you brought up Maker earlier and about how Maker, the DAO, sets their rates, or Sky DAO, I don't know, now sets the rates and they decide, by risk committee or whatever we want to refer to it as, this is what borrowers should pay on our system. Within Liquity, you can make that decision. So if you wake up and you read the news and you want to speculate that the Fed's going to lower rates and that will translate into lower borrowing rates in DeFi, well, you're completely free to lower your rate and kind of move yourself closer to redemptions, because you're now where you think that Maker is going to move in 3 days, 5 days, whatever, and you can be ahead of that curve. And that's exactly what happens if you look at TradFi. It's not the moment that the Fed raises or lowers their rate. You hear about expectations, and the market itself kind of moves, and then the Fed announces. Now there can be a surprise, and they could say something the market thinks they're going to lower by 0.5%, and the Fed decides to only lower by 25 bips, then the market will kind of correct back up to that. But it's really important that the market can move quicker than the announcement. We give that option in DeFi that you can move quicker than Maker, you can move quicker than other things. So we think that's really powerful to be able to bring that market dynamic in and democratize that, not make it a MKR voter or a risk committee that makes that decision. It is literally anybody and everybody that's borrowing or providing stablecoin liquidity in the system.
It's very
Yeah,
cool.
just quickly to touch on, you said the Fed. Kind of what happens in Liquity V2, the users become the Fed. We don't need the Fed because the market set the rates. Users become rate makers instead of rate takers. And I think it's just a beautiful mechanism. Kind of, why do we need the Fed? Why do we need governance to do that if the market can has all the wisdom to do
Yeah,
that?
it's going to be really interesting to see what liquidity rates are. I know there's like lending markets like Aave where there's fluctuating rates, but I think there's a lot of collateral on like those are kind of like pooled markets, and then the rates there might not always be super useful to look at because they're going to be influenced by a lot of factors. But like these liquidity rates are like you said are going to be like the I guess the Fed of DeFi, so it'll be really cool to see how the liquidity rates move around. And I heard that is does Liquidity also have plans to have like rate delegates or something to so you could delegate someone to help manage this for you?
Yeah, yeah. So let's kind of take both those things because that's a great question you just asked. I don't know if you can see the student dashboard I pulled up.
Yeah.
Cool. So uh, we have built this. There's lots of different metrics in here, but this is my favorite graph, and this came from the guys at Parsec actually gave us the idea of how to build this. So shout out to them. But this is essentially on this interest across collaterals. The different colors represent um, wrapped ETH in orange, sorry, Rocket Pool ETH in orange, ETH in purple, and Lido in blue, and their relative size of borrowing, and also the interest rate they pay. So what you can see kind of in the beginning when we first launched 2 weeks ago is everybody set their rates quite high, and it was up around where it would cost to borrow on Maker or Aave 2 weeks ago. And then very quickly it kind of dropped off because people realized there's two big differences in what we do compared to an Aave or another borrowing protocol, lending borrowing protocol. And I'll come back into Maker in a second. But what happens if you want to borrow on Aave is first somebody needs to bring stablecoins into it, uh, and they're earning nothing initially. So they seed essentially that. And then somebody comes and says, hey, I want to borrow stablecoins, USDC, USDT. And they can borrow from that finite pool of assets based off the supply and demand of assets in there, and everybody else wanting to do that same thing. They bring their ETH collateral or their Lido collateral, and then they can go pull out of that. What that means is essentially at any given time, you always need to have this kind of excess supply of stablecoin. With a CDP like us or Maker, we mint on demand. If people put collateral in, they can take that out. So a lot of people looked at that Aave rate and they said, what does it cost to borrow an Aave today? And that tended to be higher. The second thing is very related to that. Unlike Maker, unlike Aave, we pay 100% straight out the door to stability pools and what we call protocol incentivized liquidity, which for us right now means Curve and also the DeFi Collective, an association that we're working with that puts that money into different AMM protocols, different liquidity protocols to try to increase liquidity further. All that money's flowing straight out the door. Every single week, that mechanism, which will flip over tonight as we're recording this, tomorrow morning, Thursday, into those protocols again to kind of refill up those pools. That
Wow,
means we're just really efficient because we squeezed all the margin to zero.
wow, that's amazing. So like yeah, your users get all the benefit. That's super cool.
Yeah,
So
and
the second,
what will be interesting to see is just kind of we expect that we should get in Liquidity V2 the tightest rate spread between borrowing and earning. So yeah, I think it's just a very competitive, efficient system. It will be great to see the rates. Maybe, Colin, you can show current rates. So the protocol has been live since 10, 11 days. It has reached yesterday 100 million in TVL. Yeah, and here you see the current rate numbers, borrow numbers in the system.
You can see on the left side, there's these very big numbers, particularly the ones in Lido. So this is for people providing into the stability pool, which we'll come back to. They get a benefit out of liquidations. Obviously, as we said, about 24 hours ago, as we're recording this, there was a big drop and we had some liquidations in the system, which translated into pretty big returns for people providing that safety. So that's why those numbers are very elevated. But borrowers are paying between 4.75% and 6.5%, depending on the collateral. And they're receiving, basically turn that stablecoin around and put it in the stability pool on an annualized basis, anywhere between 13 and it's quite exaggerated at this point. Let's say 13 and on a slightly longer term, closer to 30-40% APR. So
Wow.
it's quite attractive. Obviously, there's this spot one that's sitting there at very, very high because of that liquidation. But if we discount that a little bit,
Yeah, that's really good. But yeah, so yeah, the other cool thing about the borrowing that I forgot to touch on is that like if I understand V1 correctly, I think on V1 it was just like ETH collateral, but now you guys also have LSDs, and that's pretty amazing because then you have like this like yield bearing collateral, which reduces like the liquidation risk. It's just like very cool over time. Yeah.
yeah. I mean, the hope there is loans can become very close to self-repaying. It's not a self-repaying system, but having an LST collateral that increases in value over time, and hopefully ETH also goes up quite a bit. That does to a large extent offset the cost of doing borrowing. We'll see where they kind of equal out, but it does bring the user a benefit. We always offer the solution for people that only want to use ETH as well. That we're not forcing anybody to only use an LST. And we do, to the greatest extent, try to segregate each collateral into separate markets. We call them branches on the back end. And a user interacting only with the ETH, wrapped ETH part of the system is only interacting with the risks associated with that market. And to the greatest extent possible, they're only connected at the stablecoin level is segregated from the risk in the market of what's happening in Lido and Rocket Pool.
That's pretty cool. I feel like you guys have really thought through the risk of this stuff, which is really cool to see because like I've been in DeFi for a while and then I've used some stuff and gotten rugged or gotten hacked or like I haven't gotten liquidated, thankfully, but
Yeah.
there's a lot of like sketchiness out there, so it's cool to see like a protocol really like go to the nth degree to make sure everything's like safe and risk adjusted. Yeah.
We
Yeah.
have done a whole lot on that and spent a lot of time doing auditing and modeling and knock on wood, fingers crossed. But having kind of coming into this and having seen this at other shops, I think Liquity does take security very, very seriously. And especially when you're dealing with immutable systems, we don't have really any room to maneuver. We have no more control over the system than you or any listener does. So making sure that we get it right on the first go is mission critical. So it's been very enlightening joining and seeing kind of that security focus from our engineers as well as our partners that we've worked with on audits and economic modeling.
That's very cool. Yeah, so the borrowing side is really cool. Could you talk about like the earn side of it, like the stability pool and stuff? Because like that stability pool APR looks very very juicy right now.
It does, it does. So just before I jump in there, let me just give a quick mention because you brought it up earlier on the borrowing side.
Yeah.
We saw users are setting their own rates. We do have a feature in there where any user that's doing borrowing can delegate that rate setting mechanism to a third party. There is a trust assumption there. Happy to go into more depth on that. If users want to know more about that, highly advise you check out our docs. We'll come back to that, or come join our Discord and hear a bit more about that. But we are looking to grow that, and we'll be communicating more in the coming weeks and months about kind of that growing ecosystem. But as you said, what is probably more
maybe
interesting.
just quickly to finish up the borrowing, and then we can switch to the earn part. But as I said, I think user set rates are cool, give you more control over the rate. I think something we shouldn't forget that was also there in V1 or the high loan to value ratio. So makes it very capital efficient also to leverage up, or in a downturn like 24 hours before, you are liquidated later than in other places. That's how I look at it. You have more safety margin than in V1. Yes, and the third thing, which is interesting for borrower, is the PIL. So kind of revenues going into liquidity is relevant for borrowers that they know they can get in and out of the stablecoin, which we call bold, in a predictable way. So in other protocols, you need to hope that governance pays out for incentives, somebody votes for incentives. So there are stronger guarantees. And I think this overall is the borrowing proposition. Yeah. Just wanted to finish that up, and then let's move to the earn side.
No, that's amazing. Actually, the LTV is like, yeah, that's a very high LTV. So yeah, I guess you guys have really efficient liquidations because of the stability pool, which lets you guys achieve that.
Yeah, great segue into that. So how does liquidation work, and how does that fit in with earn? So we have what we call stability pools. We saw them in action, as we said, not too long ago. Essentially, this is people take their bold and they put it into a special smart contract, completely autonomous like the rest of them. And that earns 3/4 of that borrowing revenue. So 3/4 is instantly kind of conveyed into people that have put their bold willingly into the system. In the event of a liquidation, rather than needing like a maker and Aave model, rather than somebody needing to go out and bring external collateral to repay debt, we take from that stability pool. This provides ample, always available, or hopefully theoretically always available. It can be replenished in an autonomous transaction, or sorry, an atomic transaction. So in theory, this should be able to go on to whatever size we need. But users that want to hold their stablecoin, earn on their stablecoin, also partake in this liquidation safety mechanism. When they do, what happens is their bold is swapped back for the underlying collateral, be it ETH or an LST, and they get that at a 5% discount, meaning at the moment that happens, which generally is in what we call a forced selling, meaning the borrowers are executed at the worst time for them, but the best time if you're a dip buyer, which is what we saw happen during these liquidations the other day. Users are buying $1 worth of LSTs or ETH for 95 cents at a price that's already, as the market crashes down and people get liquidated. On average, historically, that's proven to be quite profitable for a position. What we saw is those big spikes in those numbers, which you can see in front of you, with that APR number on the 24 hours and the 7 days basis. However, when liquidations are not happening, you're still earning a pretty good yield because 75% of that borrowing revenue is coming back in. So that's a little bit more representative, what you can see inside of Rocket Pool, where we didn't experience any liquidations yesterday. ETH is a little bit kind of in between, and Lido is a bit more leveraged, as you can tell. Lots of money passing through that. It should keep this hopefully very much in line with borrowing rates and even quite attractive. Currently, as it stands, it's cheaper to borrow than it is to be in the stability pool. So it is quite profitable to put in your ETH or your LST, borrow against that at about an average rate, deposit that into the stability pool. How long that arbitrage will last depends on how many people are, I guess, listening to this podcast.
Mm-hmm. That's super sick. So like I feel like if you just put in like LSDs and then you put a reasonable amount into the stability pool, then you get like a really good APR. And there's a little bit, the APR is also a little bit like counter trend to the market because you get like more if ETH price comes down from harvesting the liquidations there.
Yep.
That's quite good. I think I might start doing that myself.
Yeah, and I think what's interesting and really differentiating is then if you think about in what kind of dollar you're earning and the yield profile you're getting. And I think there we are really unique because, okay, to earn this yield, you hold bold the stable coin, which is, I call it a very hard dollar. It's only backed by ETH and staked ETH. It's 100% on chain. You have full control. It's unstoppable. It's actually very liquid because it's as liquid as the underlying collateral because you can always redeem against the collateral. So kind of, I think for somebody that has ETH or kind of is an ETH believer, I think that's a very reassuring dollar to hold. And then on top of that, if you're staking in the stability pool, yes, you earn real and predictable yield. The yield is coming from the borrowers, predictable because it's the market rate. The users, the Fed that set the rate. So, if you're in there, I have strong guarantees that the rate isn't fluctuating with, like, for example, with funding rates or utilization. So that's great to know. And you get it in bold. So it's really in the stable coin, which again, it's a stable coin you can always redeem into ETH. So I think for me, it's like a savings account, or I compare it like to DeFi treasuries, probably the best risk-adjusted yield once the protocol has hardened for users to get. So I think that makes it really interesting. And with the additional benefit, of the liquidations, which aligns with ETH Believer is, so while I was sleeping 24 hours ago, I bought ETH at 2,300 just because I was in the stability pool and I participated in the liquidation. So in a nutshell, what I think is exciting from the earn product view, and not only exciting, I think the really important part is that people understand the differences of the stable coin and the yield. And I think there aren't many other places where they get this kind of risk profile of the stable and the yield.
Yeah, that's really cool because we do a lot of farming, and then a lot of our farms, if you're farming a governance token, that's kind of like correlated with the market. Market goes up, your APY goes up. Market goes down, your APY goes down. Or if you're like holding Athena, it's the same thing. You're farming the funding, and it's very market correlated. But then like here, it's a little bit market uncorrelated. So it's nice to have like this kind of like more robust and I guess like less correlated yield, and coming from like a pretty solid source as well. So.
And yeah, actually, you could say, we have built that. Who's the ideal customer? It would be the Ethereum Foundation. They have the ETH. They don't give up much control if they borrow, or they still have full control. Collateral is not rehypothecated like in lending protocols, and they can earn in hard dollars ETH-backed real yield from DeFi, and even better, all the assets stay on chain and don't go in TradFi banks. Yeah, and treasuries too. I think it's an interesting proposition for treasuries too.
Yeah, they're starting to use Aave, right? I think we should definitely show them on Liquidity. It would be pretty cool to see them use this.
They should use them
we
all,
did join
but I
their-
just, because as I said, they're differentiating and they have their good reasons. But yeah, I kind of, if you're ETH believer, we will be very value aligned.
For sure. Yeah. I saw that there's also like some new features here. So like this multiply thing. Are there new strategies or opportunities that V2 offers?
Yeah, so this is something that was kind of present. So one of the kind of key things about Liquidity, and you did touch on it, is we don't run any of our front ends. So the front end that you can see that I'm sharing here is run by an external third-party team that owns a domain called liquidity.app. We're not affiliated with it. This is completely a third party that owns this domain, manages and owns this deployment. And they've been a great partner with us in V1. And they're come along the ride with V2. It's great to see kind of this community support in doing this. One of the other partners that we have that has been with us since the very early days in V1 is DeFi Saver, a great team. We love their products. We are big users ourselves. A lot of our users exclusively use them, and they've done a lot of really cool things, including kind of natively offering a very good solution around multiply. But something that we did hear from a lot of users is, for one reason or another, they like to be able to use kind of the core contracts the Liquidity team has brought in. And what they were looking for is kind of a multiply feature, the ability to do looping. So that's something that we're looking at integrating. We're waiting for that Liquidity to build. It is heading in a very positive direction. And inside of our native front end kit, the teams like liquidity.app or lqty.io, amongst, I think we're up to about 4 or 5 others that are coming online. And we do expect to see more people run this, as well as we're looking to offer solutions where people can run these locally. We'll be able to tap into that liquidity source and provide leverage without ever needing to leave their own desktop environment, which we think is really, really cool for somebody that cares about DeFi, decentralization, and running their own front ends in a very sovereign basis. The protocol is robust. The user experience should also be robust. So that's something we strongly believe. And this multiply feature is an ability to capitalize on that by leveraging direct liquidity out of AMMs to be able to place collateral in, borrow bold, sell bold for more collateral, place that back in. And we think this is something that users will want to be able to do, as I said, in a very sovereign local way, coupled with being able to do this through more established solutions that have always kind of the state-of-the-art liquidity through things like DeFi savers. So giving the users a choice is something we felt very strongly about, and that's why we'll be bringing this product online.
Very cool. Yeah, I like that you guys have like built like this like very solid, robust, decentralized stablecoin primitive, and then these partners that you guys are working with can build on that and like implement more features on top. Are there any other more integrations or like do you guys have a like how do you guys see V2 evolving?
Yeah.
And maybe like for instance, I know there's like some forks like on Arbitrum. There's like Nearite is one of the forks that you guys are working with. How do you guys see things going forward?
I think there's two aspects, and I'll let kind of Michael come in and talk more strategically. When I came in, so V1 is nice because it is autonomous, and I kind of think of it as a monolith. People have integrated with V1, but it serves the purposes that it serves. And one of the things when I came in that we started talking about with the team, that we thought that there was a lot of angles to kind of open up the protocol, build a robust kind of primitive, as you've said, that offers this borrowing as well as some other features you need. But there's a lot of opportunities, especially with the way that it's run, with having users set rates, that opens up the possibility to build a lot more out of this system. And I think that there's a lot of kind of our medium to longer term growth in TVL will be for people wanting to use Liquity V2 for something that is much more complex than a borrowing and stablecoin system. These can be things like perps and derivatives hedging. This can be things like fixed term borrowing that uses us as a backend. So what I like to say is if we're very successful, we'll have users that have never even heard of Liquity or Bolt. We really believe that this can be kind of a core component as it proves its own ability to, in a very efficient way, build leverage, build borrowing, and help users better utilize their collateral, as well as their stable assets. When we're able to do that, you can abstract all that user experience away and put it into your own brand. So we see a huge growth opportunity from people being able to integrate first from just regular delegations, manage somebody's borrowing rate. It would be great. And we heard a lot about Coinbase working with Morpho to give kind of a centralized exchange experience with DeFi rates coupled in a way that users are not even overly aware of what's happening. Users can use our system in a very similar way. We had with V1, big firms that were working with large high net worth individuals offering loans through V1. V2 answers a lot of the concerns they had and delivers another driver into that. So that's kind of the first setup, and delegation is part of that story. Beyond that, rate delegation can also be used in a way where there's fixed length, fixed term borrowing, where users can enter into something that looks like an interest rate swap. For those that are not familiar, interest rate swaps are the second largest market in the world after Forex. These are literally trillion-dollar markets. Governments need to hedge against other governments' interest rates. Big companies need to hedge against that. Central banks hedge against the dollar interest rate. These are massive markets. And DeFi needs to be able to interact with that in order to kind of get beyond the very highly liquid short-term borrowing into that kind of medium term where companies would finance themselves. Or where maybe you as an investor says, hey, I have lots of ETH locked up. I want to borrow to enter into this locked deal to finance a company with a 6-month to a 3-year horizon. And that's really where we see a lot of this bread and butter. Beyond that, the forks are another story. We are in a very conservative set of collaterals, conservative risk parameters on mainnet. Obviously, a lot of users are very interested in V2 L2s or in alt L1s, different types of collaterals. And this is why we've been able to partner with 15 plus companies that are bringing different iterations, different flavors of Liquity V2, either into a new network or with a new set of collaterals, or possibly with both. So we think that's a huge upside. And it also offers users the ability to kind of pick from things where those projects are working to build a better product and not just fighting with each other to have a better Ponzonomic and more token emissions. So we think it's really a win-win for all our parties there. And it really comes from this kind of opening up and trying to be a primitive rather than a monolith.
And to add on that, I think why forks like it is because this primitive allows them to have a credibly neutral base dollar in their ecosystem against their base asset on their chain or L2 and get cheap credit, as an alternative to USDC or USDT. So I think that was driving a lot of the fork success because people just liked this system and this autonomous way how it can provide it. And on the integration side, I think something Colin didn't mention, but I think which is also important is this immutability and predictability. If you want to have a DeFi primitive and it can change all the time, it's just hard to build on top of that. And I think that's a strength of V1 and V2 that people can build on top of it because it won't change. So you can integrate it in a different way because you know how it works. And that's actually also important for users, but even more institutional users, that they don't need to do the due diligence on an ongoing basis because they know terms and conditions are set in stone and it's not kind of changing all the time. I think that's also an aspect that makes V2 unique.
That's very cool. Yeah, I mean, V2 sounds really good. So for people watching this podcast, how should they get started with V2? Do you guys I guess they can go to liquidity.app and start opening a trove. Do you guys have any reward programs going on? Are there any farms that people should be aware of? I guess the stability pool is one, and then there's also protocol incentivized liquidity or anything, or how should they get started here?
Yeah, so kind of as you alluded to, we have two ongoing things. So the first one is the stability pool receives funds from borrowing. So right now that's incredibly attractive compared to other solutions where you put USDC, USDT into something, or even other CDP-based protocols. I would say 15 to 30, 40% on an annualized basis is incredibly attractive in the current market. So something to keep in mind, and that is on an ongoing basis. That's not us pumping money into it. The second one is protocol incentivized liquidity. I said stability pools get 75% of the revenue. The other 25% goes out on an ongoing basis from borrowers to stimulate liquidity. And that's directed by LQTY stakers who are able to interact with that every single week to decide where that money should go in a gauge-like system. If you're familiar with the solidly forks like Aerodrome or Velodrome, amongst others. It works in a very similar way. So that's kind of the first part there. Then on top of that, as alluded to, forks is something that's coming. We've had a number of announcements so far where forks are giving users of our V1 system, so stability pool
the V2
earners,
system, Colin,
as well as PIL liquidity providers benefit from up to 4% of their token supply.
Nice. Okay.
Because you said V1 system, so it's using the V2 system, they get incentives for using the stability pool and liquidity. So this will pan out. They will announce it. They have some discussions how they will do it. But I think, yeah, at least you not only have the yield, but potentially kind of more on top, more to be disclosed by the forks. And the liquidity pool that Colin mentions currently, Curve, Bold, USDC, Bold, LUSD, are hooked to the incentives directly from the protocol. In the future, maybe it's then also Uniswap V4. And where can people learn about it? Liquity.org. On the website, you find all the resources. There are a lot of blog posts which give you some background on the concepts. There is a docs page with Q&A. There is a great technical README. I think, yeah, that's really outstanding. Haven't seen kind of that in a lot of protocols, which explains you everything. We have a risk disclosure section, so you understand that. So you see, we really want to make sure people have all the information because, as Colin said, at this point, we, the team, or others, don't have more information or control than other users in the system. And we really want to make sure people have all the information because it's also their responsibility. Now the protocol, it's out. Almost like a public good. Everybody can interact with it. but you also need the information, and yeah, always do your own research on that.
Cool. Yeah, it sounds great. Is there anything you guys want to leave the audience with? Or?
We'd love to see you. Come check out liquity.org. Come join our Discord. Find us on X. Ask questions if you have them. Would love to see you as users. Would love to hear your feedback. If you are a current user or past user, you think you're becoming one, feel free to drop us comments in our Discord. We also have a Google form. We are a new protocol. We launched 2 weeks ago, as we said. Would love to hear more feedback about how we can improve. As we said, we don't run our front ends, but we do provide kind of a base kit that people that run front ends can use. Always eager to hear more about how we can just make the experience better. So strongly feel that this is an opportunity to offer an incredibly efficient system that we want users to use and will deliver a better economic benefit than a lot of the competing solutions. So we're big believers. Obviously, we've been at this for more than a year, but we hope that people will be pleasantly surprised of what we've been able to deliver as an iteration since V1. And would love to hear more about your reflections, whether they're positive or negative, about how we can get better.
Oh, yeah, this has been a great interview. I really love what you guys are doing. I like that, obviously I like that you guys are decentralized and stuff, but also that, there's like really good yield and it's like coming from organic sources. And yeah, I feel like you guys are setting like a really good example for other protocols in DeFi as well. Like, a few months ago, Vitalik was like, DeFi is all Ouroboros or whatever. And like, just like looking at this stuff, I'm like, actually there are decentralized protocols out there, that are adding value, providing really good use cases, and the yield is not like just like a Ponzi or something. So yeah, this has been great. So yeah, I really encourage anyone listening to check out Liquity V2. It seems like it's really good, opportunities there as well. And yeah, yeah, thanks for watching.